Anyone who doesn't know me, Matt Erdman is my name. Just kind of bulleted background. Husband, father, those are the two most important roles in my life. Real estate wise, have been a realtor, independent realtor. I've run a small team. I've been a team leader for a market center. I am currently the owner and OP of KW Legacy Partners. I've been a MAPS coach, regional director, regional operating principal for New England, co-founder of RE Profit, real estate investor. Those are the highlights. And today, this is kind of one of my favorite things to do, not necessarily taxes, but having conversations around how we hold on to more of the money that we work really hard in order to create. And that's what we're going to talk about today. That being said, very important disclaimer. While I am many things, I am not a CPA nor am I a tax attorney. So all of the information provided is for information purposes only, and any attempt to use this information should only be done after consulting with an actual qualified professional, which is not me. I'm just a guy who knows some stuff, who's sharing some stuff. My goal here is to share enough information, and kind of all the joking around the disclaimer aside, it's not our job to become tax attorneys, but I do believe it's important and incumbent upon us to learn enough to be able to ask enough of the right questions so that we end up doing the right things in order to minimize our tax liability. So the key today is to listen, learn, and then verify with a professional, right? So my hope is you get some ideas, some thoughts, some things from this that you can go back to your CPA or your tax attorney and say, hey, should we talk about this? Does this make sense for me? Does this fit into my business? Okay. So we're going to cover some of those key things. Number one, I feel like having this conversation, it's wise for us to kick off with just the three pillars of wealth, which I talk about often, right? We tend to overcomplicate just about everything in our lives. Most things are far simpler than we make them out to be. If we think about wealth building at its simplest form, these are really the three pillars, right? In order to build wealth in our lives, we need to be able to generate income. If we can't generate income, we can't save income, we can't invest because we don't have any income to save or invest. We can generate all the income in the world. If we don't save it, then we're never going to build wealth because we're not holding on to any of the money. So we might be a high income earner, but that is a very different thing than being wealthy, right? So if we can generate it, but we don't know how to save it, then we're never going to get over that hurdle to really start to build real true wealth because we don't have any savings and we don't have anything to invest. And then lastly, if we can generate income, save money, but we have no idea how to invest it, then the reality is we're probably going to have a pretty healthy bank account earning 0.00 something, or in today's market, maybe a high yield of 4%, right? Which is a very slow burn. The reality is to build wealth, we have to make money, save money, and invest money, right? Those are your three pillars. Kind of breaking those three things down quickly, and then we're going to dive into the tax stuff. Number one, generating income. I think these are the three most important pieces of learning how to build income. One is just as much of a duh statement as this should sound like. Just get really good at what you do. I don't care if you're a carpenter, a roofer, a dentist, a plumber, an attorney, a realtor, a mortgage lender. When you get really, really good at what you do, you tend to be a top earner in that industry, right? So focus on being really, really good at what you do. That's number one. Number two, know what activities inside of your job, right? Because remember, even though we are self-employed, the reality is there are things within our business that we have to do. Like that's the job part of our business. But know the things within our job that actually generate the most amount of income. Those are the skills that we want to master, and those are the things that we want to spend the most amount of our time doing, right? So if we start thinking about an hour like a dollar, right? When we think about investing money, we think about what's an acceptable return for every dollar I put in. We should start thinking about our hours similarly, right? Where am I investing my hours, and am I getting the best return that I could be getting for the hours that I'm investing? So understanding what are the activities that generate the most amount of income, and building out our business to let us spend the most amount of time doing those things so that we can generate the most amount of income. And lastly is leveraging the other activities away, right? So being able to leverage those important activities. The fact that they are less dollar productive does not mean they are less important. It just means they are less dollar productive. Learning to leverage those things away so that we can reinvest that time back into the more dollar productive activities. That is how we grow our business, right? If you think about business growth at its absolute simplest form, most of us, when we start, we're the butcher, the baker, the candlestick maker. We have to do everything. Over time, as the business grows, we have more capital to invest, right? We tend to have less time because we're getting busier. Just think of it as a loaf of bread, that as the business grows, we're just slicing pieces off, and we're slicing them off in order of least dollar productive activities first. Again, reiterating, least dollar productive does not mean least important. But if you think about business building at its simplest form, that's really what it looks like. In the beginning, I might have to do it all, but as we develop and we get further along, we start slicing things off. All right, somebody else can do this, a system, a tool, or a person. That frees up some of my time so I can go back to doing more dollar productive activities. That's how we maximize our income. Then we have to be able to save. Number one, if we're going to save money, we have to have a personal and a business budget, which also means we need to have a profit and loss, right? Those are the two financial tools most foundational to being able to make money, save money, or build wealth is budget and a profit and loss, right? The budget is what we should be doing. This is what we've decided we're going to do. The P&L is our scorecard. How well are we doing? This is what we said we're going to do. This is what we actually did. Do they match? That's how we should think about those two tools. When we have gaps, then our job becomes to close those gaps. And that's how we maximize our profitability, which allows us to save more money. Number two is leverage tax strategies to allow us to hold on to more of our money, right? The people who really hate tax law are the people who don't know tax law. And then keep our lifestyle in check. The reality is that is probably our number one Achilles heel in our country, is we tend to increase our lifestyle in tandem with our income. When we do that, then our lifestyle chews up everything that we make, and there is nothing left to invest, which obviously short circuits the wealth building process. We have to have a gap between our earnings and our necessary income to survive and sustain our lifestyle. Without a gap there, we have nothing to invest, right? So a big part of that is keeping our lifestyle in check. It doesn't mean suffering, right? It just means keeping it in check. And then lastly, invest. 3 keys is to learn. Build the team. So as we learn, we start to bring the people around us that are going to help us through that process, whether it's people we can learn from or professionals who are going to help us implement, financial advisors, CPAs, tax advisors, all of those different professionals. And lastly, take action, right? Procrastination is the death of every dream, right? So end of the day, we got to take action. So investing is about learning, building the team around us, and then taking action. So let's lean into the tax side of things. So one, we're just going to rip through the kind of the basic deductions that we all should be looking at and probably taking in our business. So these are just typical expenses that would be business deductions within our real estate sales business. We've got marketing and lead gen, salaries, occupancy and home office, technology, phone, training and education, equipment, office supplies, auto, right? Those are probably your top, whatever, however many that is, top 10 deductions. You could probably throw travel in there. But those are your primary key deductions that most everything that happens in our business can fit into one of those buckets. By the way, just trying to bring simplicity to a thing that often self-employed people are scared of, being budgets and profit and loss. If you look at that list, that's essentially what they would call a chart of accounts in a profit and loss. All it is the buckets. It's just, when someone says chart of accounts, it's just a list of categories that the expenses go into. That's all that is. Just think of it as chart of account is just a list of buckets. When I look at a profit and loss, it's all the categories that all the expenses funnel into, right? And these are the primary ones. We're going to highlight a couple of them where there's some knowledge and or some options that we should have or be aware of. So one, let's talk about marketing and lead gen. This isn't necessarily a tax strategy, but from a business perspective, I think there's a couple things that are really important for us to know and understand with respect to marketing and lead gen. One is we need to know the difference between the two. Somebody unmute and tell me, what is the difference between marketing and lead gen?
While they're thinking about that, Matt, are you sharing slides by any chance?
Oh my gosh. I am not, but I should be. Thank you for saying that. How's that, everybody?
Beautiful.
That better? You
Thank you.
missed some great slides. Great slides. What is the difference between marketing and lead gen? Come on, don't be weird and quiet.
I'll take a guess.
Okay,
I
what you got?
think lead generation is more attracting leads to you and doing activities that will bring business to you versus marketing is more maybe attracting. I don't know. One is more active. You're actually generating and tracking the ROI.
Love it. So, yes, think of marketing. Marketing is a more passive approach. Lead generation is a more direct approach. Lead generation is me doing outbound activities in order to create opportunities. So, examples, sometimes we just think of that as like dialing for dollars, obviously in a TCPA compliant way. But there's a million ways to lead generate. When you go out and you network, that is lead generation. If you door knock before your open house and invite the neighbors over, that is lead generation. The open house itself, done correctly, is lead generation. Um, nowadays you can lead generate through social media platforms. Now, when I say lead generate through social media platforms, I don't mean posting. However, I would argue if you're having proactive real estate conversations through private messaging, right, that is a direct outbound activity intended to create opportunity. Those are all your lead gen activities. Marketing is more, I'm putting myself and my message out there for people to see in the hopes that they will reach out to me. Right. So one, I'm going to the source to create the opportunity. One, I'm putting a message out there in the hopes that somebody will come to me. That's kind of the best way to think about it. There's a few things we should know about that. Most of us, not all of us, but most of us, when we get in the business, we tend to have more time than money, which is why if you read the MREA or you talk to folks who have been in the business for a long time, we will always coach and consult and encourage you to build a business that has a foundation of lead generation. Number one, it's because early in the business, you want to invest what you have, which is time. As you do that and you start to gain momentum and your business starts to become profitable and you have reserves, you get to the point where you can start to reinvest in that marketing, right? Doesn't mean marketing has to be completely tabled, because today we have pretty inexpensive means of marketing with social media, but just understanding the difference between the two. The other thing that's important is to understand, depending on the strategy you choose, every lead gen and or marketing strategy has a dip. When I say a dip, some of you have heard me talk about this before. The dip is the gap in between when I start an activity and when I start getting results, right? Almost everything we do in life has a dip, right? If I decide I want to lose 20 pounds, there's a point in time where I decide to take action and I'm doing the work, but I look and weigh exactly the same, right? I got to put the work in for a period of time before the results start to show up. That's the dip. It's important to know when you're going into a marketing or lead gen strategy, especially marketing, have some awareness around what the dip is. Historically, that we have always said, right? The example I always use here is around farming, right? So farming is I pick a neighborhood, I say I want to develop my brand in that neighborhood and start to create market share in that neighborhood. So I'm going to get the addresses for that whole neighborhood and I'm going to start mailing on a monthly basis, a newsletter, whatever the case may be. That's farming. Historically, we have always said if you cannot or are not willing to farm a particular area for a full year before you expect tangible results, you probably should not even start. Today, that runway has extended even further. Today, I hear people say 18 to 24 months before you can really expect to see the results of farming, right? So it doesn't mean it's not a good strategy. It can be a great strategy. However, you have to understand, because if you start investing in it and 90 days in, you don't get a result and you're like, okay, this isn't working, I'm out. All you did was burn time, energy, effort, and money, right? Because you didn't give that strategy enough time to play out. And then secondly, know your ROI, right? So this is a place in our businesses that most of us fall down significantly. If we are investing money that should be making us money, we need to have a simple system in order to track that, to see what our ROI, that is hard to say, our ROI is on those investments. What are we spending? What are we making? And what's the return on investment? Right? Too often, we do what we all like to call realtor math, which is as long as I get one closing out of this, then it's paid for the year and everything else is gravy. That is not business math. That is a statement that has been repeated over and over in the real estate world for decades, probably 100 years. That is not good business math. And counting leads that you received is not tracking ROI, right? ROI is how much money have I put in? How much money have I got out? And mathematically, what is my return on investment, my ROI on that? Those are numbers that we have to track. That is how we hold the money we spend accountable. Okay. So again, not necessarily a deduction conversation, but I think three important things to know and understand around marketing and lead gen. Before I go forward, any questions, comments, or anything anybody wants to share around that topic? Going once, twice. Okay, moving on. Okay, occupancy, another very common deduction for us. There are two ways that we can take a home occupant, an occupancy or home office deduction. Again, I'm going to stress through this whole conversation. I'm giving you information. This is information you should take to your CPA or your tax attorney to discuss how it applies to you, given your unique situation. Typically, if we are deducting a home office, we can deduct it in one of two ways. One, you can take $5 per square up to 300 square feet, capped out at $1,500. It's a flat deduction. Second, which typically tends to result in a larger deduction, if your home office, you can write off, if your home office takes up X% of the total square footage in your home, then you are able to write off that percent of household expenses, many household expenses, as part of your home office. So if your home office is 1/10 of the square footage of your house, you can theoretically deduct 10% of the cost of your mortgage interest, your rent, your utilities, homeowner's insurance, landscaping, cleaning, right? All those different expenses that exist in your home. Okay. Again, you want to talk to your CPA about which strategy makes the most sense. Whether you have a physical office inside of a real estate office, are you still able to take that deduction? Those are all conversations you want to have, but those are the two different ways that the IRS allows us. And obviously, if we do in fact have a home office that checks all the boxes for the IRS, that second deduction can be pretty significant, right? We all know that all of those household bills can add up to quite a bit. And being able to take 5, 8, 10, 12% of that as a deduction can be a pretty significant deduction. The other thing I should say, just to make sure, there are two terms you'll hear in reference to taxes that I want to make sure everybody understands the difference, and that is deductions and credits. So when you are taking a deduction, that deduction is reducing your income. Because it is reducing your income, it is therefore reducing your tax liability because there is less income. So if I made $100,000 and I'm in a 20% tax bracket, that means I owe $20,000. Well, if I take $20,000 in deductions, now I only have $80,000 of income times 20%. That reduces what I pay in taxes, right? So remember, deductions reduce your income, which in turn reduce your tax liability. A credit is a reduction in the direct tax liability, right? So I owe 20, I have a $2,000 tax credit. That reduces my taxes to 18. So two different things, okay? All right, auto. So auto, similar. We have two different ways we can do it. We have a mileage deduction we can take. I believe for 2025, the mileage deduction rate is 70 cents per mile. I saw somewhere that I think it might be 72.5 for 2026. I also saw that it has not officially been announced by the IRS. They announce it annually. But as for 2025, it was 70 cents per mile. Very simple concept. You track your mileage, your business mileage at the end of the year, however many miles you did for business, traveled for business times 70 cents is the deduction you get to take. So in this example, you drive 8,000 miles, 70 cents per mile, that's a $5,600 deduction. Here's the thing I would tell you about mileage deductions. It is one of the number one areas where a self-employed individual may find themselves in trouble when they get audited, if they get audited, right? So you have to remember, when it comes to taxes, if you do something incorrectly, or you take something you have the right to take but don't have documentation to back it up, it only becomes a problem when you get audited, right? When you get audited and now you have to provide documentation to support the deduction that you took. If the documentation doesn't exist, you're going to lose the deduction. And then you're going to pay taxes and penalties or interest and penalties on top of the deduction that you lost. So when it comes to mileage, just make sure you track it. Whether you're using Mileage IQ, whether you're putting it in a notebook that you keep on your visor, whether you're an RE Profit user and you're using our mileage tracker in our mobile app, whatever you're using, just have a record. Because again, if they show up, there's an audit, and they say, cool, let me see your mileage log and the documentation for those 8,000 miles, and you don't have it, those 8,000 miles and that deduction goes away, right? So just make sure it's documented. The second option with auto is the actual expense route, right? The actual expense method lets you claim a business card deduction for a percentage of the total amount that you spend on the car. So you're actually keeping track of your repairs, all the different expenses involved, and you're taking that percent deduction based on the percent of business use of the car. Again, there could be advantages one way or the other, depending on your unique situation. These are conversations you want to have with your CPA to decide which one makes sense for you. The other one we talked about was salaries. So now we're sliding a little bit into some more advanced strategies. Okay. So we are all self-employed individuals, which means we receive a 1099 and we pay taxes based on that 1099, as opposed to a W-2 employee who has a jobby job, right? We get a paycheck, they take taxes and all the other deductions out of our paycheck. End of the year, we file taxes. Maybe we get a return, maybe we don't. So, number one, know and understand as a business, it is your business income that gets taxed. What I mean by that is if your business makes $200,000 and you only took 100 grand out of the business, you get taxed on $200,000. The IRS doesn't care how much of the money you took or didn't take if you're operating as a sole proprietor or some other pass-through entity like an LLC. Whatever the business makes, that's what you pay taxes on, regardless of how much of it you took for personal use. Now, in that scenario, regardless of what we took out of the business, again, it has no effect on taxes. What some folks do not realize is that when you have a job and you have that W-2, you're paying taxes out of every check. We all know and understand that. What you may or may not know is you are actually paying half of the taxes. Your employer is paying the other half. So one of the gifts of being self-employed is that we pay what they call a self-employment tax. Self-employment tax means that we are paying both the employee and the employer side of the taxes, right? Fun for us because we are both. We're the employee and we're the employer. There is a tax strategy that can make sense, that can reduce that expense for us, and does, once again, require a conversation with a professional where they look at your unique situation, your income, and decide whether or not this makes sense. What it looks like is this. rather than filing as a sole proprietor, you set up an LLC and you elect to file as an S corp. So an LLC is a pass-through entity, which means it doesn't pay taxes. The owner of it does. You have an LLC, the LLC makes 200 grand. You get a K1 from that says you made $200,000 through such and such LLC. You give that to your accountant. He flows that into your personal tax return. So S corps give you some additional optionality when it comes to how you take money out of the business and how you're treated for taxes. So you can actually be an LLC and you can notify the IRS that I am an LLC, but I'm going to choose to file taxes as an S corp. What this allows you to do is you can pay yourself a reasonable salary. So in the scenario on the screen, we're saying we're paying ourselves $50,000 a year. You're going to pay that through an actual payroll company where taxes are going to come out. And then you file as an S corp. What this does is it reduces your self-employment tax. Okay, so in the example on the screen, and I'm just going to run through it, we've got two individuals that are making $300,000 a year. One is paying everything normal as a sole proprietor, $300,000 based on their tax bracket. They have an $84,000 tax liability, another $8,700 in self-employment taxes, total tax liability of 92 and change. Their net income after taxes is $207,000 and change. Jump over to this scenario where we pay ourselves a $50,000 salary. Out of that salary, we are paying taxes. That salary shows up on our profit and loss statement as an expense now, which reduces the profit of the business from $300,000 to $250,000. So we made $300,000, but we paid ourselves $50,000 and we paid taxes out of that. That reduces our self-employment taxes to $7,400 and change. We have a remaining balance of $250 that is our taxable income. Our tax liability on that $250 is $155, or I'm sorry, is $55 and change for a total of $62,000. Our net income after tax is $237 and change. You can see the difference between the two. This is how that strategy can affect our after-tax income. Now, there's a space in time based on the income of your business where it makes sense to do this and where it doesn't. Because this only applies to, as of last year, I believe it was the first $146,000 of income. This strategy applies to. So once again, this is a conversation you want to talk to your CPA, your tax advisor, and say, hey, I learned about this strategy where an LLC can file as an S corp. Can you talk me through that? And is that something that makes sense for me? There's a couple of things you do have to know too. We have people on the call from all different places. Every state is different as far as what is required for you to operate your real estate sales business under an LLC. Unfortunately, well, I'm in Connecticut. That's not the unfortunate part. I'm in Connecticut. And unfortunately, in Connecticut, in order to do that, you do have to have a broker's license. Because in Connecticut, a broker can only pay an entity if the owner of that entity has a broker's license. So in Connecticut, you've got to get a broker's license in order to set up the LLC to be able to pay directly. I've heard about workarounds. I've never heard of workaround that I think passes the sniff test if you are actually audited. So the correct way to do it in our state is that. Now, I know neighboring states around us where the laws and rules are different, and it is not required to have a broker's license in order to be able to set up that LLC. So if this is a strategy that makes sense for you, you're going to have a conversation with your broker, find out what the rules are in your state. And oh, by the way, I mean, if you have to get a broker's license and it can save you significant money, then do it. Right? It would be incredibly lazy to say, I'm not going to save a bunch of money on my taxes, keep more money that I can turn around and invest into things because I don't want to spend some time in a classroom and take a test, right? Very short-sighted. So again, talk to your accountant, find out if that is a strategy that works, but it can have a pretty significant impact when you're in that right income range of reducing that tax liability. All right, some fun ones. Leverage nepotism. So if you have children between the ages of 7 and 22, you can use this strategy to save on your tax returns at the end of the year. Here's how it works. Each of your children can be employed by your business and paid an annual wage of up to $12,000. The amount is important because that's the standard deduction amount for a single individual, which means as long as you're paying them that amount or under, then they're not paying taxes, or they're paying taxes at a lower bracket than you would. So you're taking that $12,000 as a business expense. So if you have two kids who are working for you that you have on payroll and you're paying them both the max amount, that's a $24,000 business deduction that you're going to take that is going to, again, reduce the business income and therefore your tax liability. The business gets to take the deduction for the payment, thus decreasing their tax liability. The children will then file their own tax return, and since they only made $12,000, they pay no federal income tax because of the standard deduction. State is going to be different state to state. And in any case, there's going to be some savings there. The business gets to take the deduction, but the kids pay no federal income tax. Okay. So there's a couple of different ways you can use this. Number one, they do have to do legitimate work, and you have to document that legitimate work. That could be a lot of different things. Again, I would encourage you to talk to your CPA, do some research online about what potential things you could have your children doing within the business, and then run those things by your tax advisor or your CPA. A lot of kids are super tech savvy. They could be managing your social media. They could be organizing your database. They could be washing your car. They could be, right? There's a list of all sorts of different things they could be doing that you can document and then therefore compensate them on. Now, they do have to receive the money. So you're actually paying them that money. You're documenting the work that they're doing. Yet you can layer this with other strategies where one, maybe you're putting it in the bank account and you're teaching them responsibility, and they are now paying for some of the things that you pay for anyways. So maybe they play soccer, they play hockey, school clothes every year. All those expenses that already exist could now be getting paid with what is essentially pre-tax money, right? Which has a significant impact over time. You also could have them invest that money. So you could be paying them, right? Reducing the taxes on your income, making that essentially pre-tax income that you're now investing on their behalf and helping them build that financial foundation for themselves. So those are, again, all things that you can talk about with your CPA, with your financial planner. And if that is a strategy that you can employ with young children and you choose to go that investment route with them, putting that into an investment fund at that age for them, like time on task over time when they get to their adulthood, that will give them a significant financial advantage in life. Okay. The hostess with the mostest deduction. Obviously, by the way, these are not the real names of these deductions. Don't go to your CPA and go, Matt told me to ask about the nepotism and the hostess with the mostest deduction. Those are not real names. The real name is the Augusta rule. This may not apply to everybody, and you can think creatively about how it might apply to you. The Augusta rule says it allows any individual to rent their primary residence up to 14 days per year, and that income is tax-free. So here's examples of how this could be used. Number one, you could legitimately rent out your primary residence. If you wanted to Airbnb it 14 days out of the year, you wouldn't have to pay taxes on that money. Many of us, Airbnb-ing our primary residence might be weird for us. However, you could throw a client party. You could throw a client party once a quarter at your property and rent your home to yourself, to your business. If you have a team, you could have your team meetings at your home and rent your home to the business for those team meetings, right? You can think creatively about, well, what are legitimate ways in which I might go rent other space where instead I could rent my primary or use my primary residence and rent it to myself in order to make that income non-taxable. So you're creating an expense for your business and income for yourself, but the income for yourself is non-taxable. So that expense reduced your business income, increased your personal income without having to pay taxes on it. Now, keep in mind, all these things, you got to think about it just like we think about debt. We know debt's a snowball, right? A little here, a little there, and all of a sudden it adds up, adds up. Well, taxes, wealth building, all the same, right? All these strategies on top of each other, little by little, add up to a lot, especially over time. So that is something you can consider. Now, again, always talk to a professional. Number two, you want to document, you need to rent. If you're going to do that, it has to be at market rate. So you got to do a little bit of research to find out if I rented a similar place in my market, what would it cost? Because you want to be able to document that. You want to document the events that you have at the house so that if there is an audit down the road, you're able to say, yes, I did 4 events that year or 8 events that year at my property. This is what the events were. This is what I paid myself. And this is the market research we did to validate that that is a reasonable market rate in our area, right? Okay, now we're going to go into what is a little bit situational, but all things we need to think about. And this conversation is something that is important to understand also for the clients that we're servicing. So investing for cash flow and understanding the massive deductions that come with that. So depreciation. I'm going to go through this part pretty quickly because I don't want to get lost in the weeds of it. Most of us probably know and understand what depreciation is. Long story short, we buy real estate. Historically, that real estate goes up in value, right? That is historically true. The IRS allows us, when we own real estate investment properties, to pretend that it is going down in value. Easiest way to explain it is they say the expiration date of a piece of residential real estate is 27 and a half years. So the way it works, we buy a property for $200,000. We subtract the value of the land because land does not depreciate. In this example, that's 75,000. We have 125,000 left, which is what they call your basis. So you have 125,000 left. You divide it by 27.5. That's our expiration date for our depreciation schedule. That means you would be able to take an annual deduction, depreciation deduction of $4,545. Now, obviously, $200,000, there's not a lot of $200,000 properties left, at least in the state of Connecticut, and not in many places, although there are some, right? So if that's a $400,000 property, that number is going to be very different. So that's what depreciation is. And you're able to take that annually. Here's where so that is a tax strategy, period. Okay. This is the part that I'm not going to get too lost in. When it comes to depreciation, there's some rules around it that were enacted back in 1987 to make sure that super wealthy people were not taking advantage of it in a way that the government did not want them to. Long story short is a couple of the rules. One, you cannot shelter active income with passive losses. So if you're showing real estate losses from your rental properties and you're a police officer full-time, you can't use those losses on your passive rental income to reduce your active income that comes from your job as a police officer, right? There's some other rules too. As you make more money, the amount of depreciation that you can take starts to go down. The important thing is this: there are some rules that say if you work full-time in a real property trade, those caveats do not apply, and you are able to take as much depreciation as you can possibly accumulate to reduce your passive and or active income. What does that all mean? It means if you're a licensed real estate agent, which you probably are if you're on this call, if you perform at least half of your personal services a year in the real estate industry, which you're all on this call, so you probably do, and if you work at least 750 hours a year, which is 15 hours a week in a real property trade, then all of that goes out the window and you can accumulate as much depreciation as you want and produce active income, which means you make $100,000 selling real estate. I rack up $25,000 in depreciation for my investment properties. I can reduce my 100 to 75,000 that I get taxed on. Okay. That is actually a really, really big deal. Now, here's where it gets more interesting. There's a thing called cost segmentation. We're going to go through this quick. I've done entire webinars on this, the strategy and how you use it. Cost segmentation was largely used in commercial historically, but it is also available to be used in residential. Cost segmentation is you buy a piece of property and you break it into components because different pieces of the real estate actually have different expiration dates, meaning different depreciation schedules, right? So you've got the real estate itself that has that 27.5 if it's residential. But there's pieces of the real estate that fall into what would be called personal property. Those depreciate at 5 to 7 years. And then you have land improvements that depreciate at 15 years. So when you do a cost segmentation, think of it like this. Somebody's going through and doing a special appraisal. You either hire an appraiser who is qualified to do this, or there are some DIY models that you can use to do this. If you go to DIYcostseg.com, you can find some information about that. Again, talk to a professional. But essentially what they're doing is they're pulling it apart and saying, okay, this chunk lives inside of the 27.5 bucket. This chunk lives in the 5 to 7 bucket. This chunk lives in the 15-year bucket. When you do that, the IRS lets you fast forward your depreciation. Right? So now maybe 80% of the value lives in that 27.5 bucket, but now 10% of it lives in my 5 to 7 and 10% lives in my 15. So now I get to take that 5 to 7 bucket faster, and I get to take that 15-year bucket faster. So the best way to think about it is it fast forwards your depreciation. I get more of it today instead of tomorrow. You are not getting more, you're just getting it sooner. By doing that, that reduces our tax liability further immediately, which allows us to keep more money in our pocket, which we hopefully then turn around and reinvest. That is why people do cost segmentations. In big commercial buildings, it can be massive how it impacts taxes. So this is just kind of the explanation of how it works. We already went through one of those examples. Here's the piece that applies at a very, very high level for real estate investors, which we all should hopefully be in that bucket or moving towards that bucket, given this is the space in which we make our living. There's a thing called bonus depreciation. Keeping an eye on the clock, I'm going to go kind of quick with this. Bonus depreciation says anything that fits in any of the buckets that is not 27.5, we can take in a lump sum deduction the year we buy the property. Okay, so that means I buy a property in 2022, because you notice I have a little graphic here. I buy a property in 2022. I do a cost segmentation on it. And let's just say, theoretically, there is $40,000 that fits into those 5 to 7 and 15-year buckets. I get to take a $40,000 deduction that year in one lump sum, which reduces my income by $40,000. Therefore, reducing my tax liability. So real scenario, $365,000 house, cost segmentation, put about $80,000 in those separate buckets, which meant if you take a deduction of $80,000, reducing your income, so that's $80,000 of income you've earned that you no longer have to pay taxes on. If you put 20% down on that property, you probably just got about 50 to 60% of your deposit back in tax savings. That is how significant it is. Now, if you look here, you'll notice, so I did a real life example of that property that was on the previous slide. And in that scenario, doing what would be reasonable math, there was about $18,000 that would fit into those 5 to 7, 15-year buckets. That means that person who purchased that investment property would be able to take that deduction the year they bought the property, reduce their income by that much and therefore their taxes. Now, when bonus depreciation, right? So remember, those are two different things. You do a cost segmentation to accelerate depreciation. Bonus depreciation was put into effect in 2022, allowing us to take those buckets in a lump sum year one. But it was phasing out. So 2023, it went to 80% of what was in those buckets we could take as a lump sum. The remainder had to follow the schedule. Then it was 60%, 40%. 2026, it was supposed to go to 20%. However, there was a significant bill that was passed last year with a really goofy name. And there were quite a few things in there that were beneficial to real estate. So we're going to cover a couple of those really quick, one of them being bonus depreciation. Bonus depreciation returned at 100%, meaning we're back to being able to take 100% of whatever fits into those 5 to 7 and 15-year buckets as a lump sum deduction the year we buy a property. You should know this. Every one of your investor clients should know this. Every one of your clients who you are trying to turn into an investor should know this, because it is a massive, massive, massive opportunity for wealth building. It is huge. So as of right now, and anything in here that says permanent, keep in mind, it is as permanent as the existing administration. That just means until it's voted to not be permanent, it's permanent, right? All these things could change. Like any voting that is happening could have an effect, which is why you've always got to stay in conversation with your CPA, so you're up to date on all this stuff. But long story short, they brought that back to 100%. It is supposed to be indefinite and or permanent going forward. Huge benefit. Another benefit to the cost segregation gains, another way to be able to take that depreciation is when you do major repairs that we tend to call CapEx repairs or capital expenses. That's like you put a new roof on. The IRS typically doesn't let you take that as a lump sum deduction, even though you spent all the money. There is a schedule for that where they say, no, you've got to take that expense over 10 years, 15 years, whatever the case may be. One of the changes within the bill that was passed last year, you definitely have to talk to your CPA about it. But the long story short is there's way more flexibility for some of those things to be deducted in lump sums, because they are trying to encourage investors to invest more in the real estate they have and buy more real estate to invest in. So some of those things, like a roof, might be something that an investor can take a lump sum deduction for, which obviously, if it's 20 grand to put a roof on, but I get to take that deduction the year I do it, well, that roof just got cheaper. It cost me less money to do that roof because it reduced my income, which reduced my taxes, right? Another thing for investors and landlords, a 20% QBI deduction. So this essentially says that landlords can, whatever their total rental income was, they can take a deduction of 20% of that. So essentially that's 20% of your rent roll that you do not have to pay taxes on, right? This is in this presentation because long-term, these are the kind of strategies, right? So there's the deductions that we take, there's the things we can implement, like the Augusta rule or employing our children, right? Our home office, there's things like that that we can do that reduce our income and therefore reduce our taxes, which allows us to keep more money. But then we are able to invest that money into things like real estate that create more cash flow for us, create more net worth for us, and when done correctly, also layer on top of all those other strategies to reduce our taxes, right? One on top of the other, on top of the other, on top of the other makes a massive difference over time. Mortgage interest deductions, again, talk to your CPA about that. But there's more flexibility as far as businesses being able to deduct mortgage expenses. So talk to your CPA about that. This directly affects taxes, especially in certain states. The SALT deduction was capped at $10,000 up until the new bill. which has now expanded it from $20,000 for an individual to $40,000 for a couple filing jointly. Basically, what that is SALT is your state and local taxes. What it allows you to do is take a deduction for those local taxes that you've paid. And the real purpose of this is to make home ownership more affordable in the areas that are very high tax areas, many of which are in New England, Connecticut included, right? So if I have to pay high property taxes, but I also get to write off a bigger chunk of that, then, right? I'm paying less taxes, which means I get a little bit of what I had to spend back, which makes home ownership in those areas a little bit more affordable. Again, something you should know and understand for your clients as well, to make sure that they know that and understand that. And then we're going to wrap up, and I'm going to take any questions, comments you have. One other thing that I want to reiterate is right at the very beginning, we talked about the fact that you have to have a budget and a profit and loss in order to be able to implement any of these things. There are far too many of us in the industry that think about profit as an afterthought instead of the purpose of our business. And if we're going to function like it's the purpose of our business, we have to have a tool, a process, a system to be able to manage our money, have a budget, and a profit and loss. Many of you know I own RE Profit. I developed RE Profit. I created RE Profit. I believe it is the simplest and most effective tool. That being said, I don't care so much what you use as long as you have a tool and a system that you're actually using that actually works and does all the things we talked about. It gives you a functioning P&L. It gives you a functioning budget. It tracks things like the ROI, all those important things so that you can really function like a business, maximize profitability. If you want to scan the QR code, it'll bring you to a sign-up page that gives you pricing and some details around it. You can also go to reprofit.com to check it out. And you can feel free to call me, text me, all different ways if you want to get a demo, any of those things. But I really do urge you, and this is not because I want to do a sales pitch. If you are operating without those two tools in your business, you don't have a business. You have a hobby that either makes money or not, and you probably don't know the difference. Right? Businesses have budgets, businesses have profit and loss. Operating a business without those is like having a car with no headlights. It's dangerous and it's dumb, right? So just don't do it. So again, whether it's this or something else, put a tool, put a system in place. That being said, Cassie, do we have any questions in the chat?
We do not have any questions in the chat. An additional plug for RE Profit. You mentioned you don't care what they use. I want to just add that it is set up against, or not against, but with real estate, by real estate agents. Like, so it's for specifically the way realtors function, as well as KW agents specifically. Any agent can use it, but there's the whole MREA budget of accounts taken into consideration and stuff like that. So when you have used your own, like way back in the day when I did some of this, I used like mint.com or whatever, QuickBooks, and there's a lot of altering you have to do in order to get all these pieces together in one spot, whereas RE Profit, it's literally just all in one spot for you.
Yeah.
So
Thank you
I
for
just
that.
wanted to add that.
So the very quick idea connects directly to the bank accounts, credit cards that you use to run the business, pulls the transactions in. A very high percentage of them are going to automatically be categorized. In 2 clicks, it creates a budget. It all functions off the millionaire real estate agent models, which again apply to everybody, no matter where you work. But all that stuff is just built in. So it's easy. You don't have to know and understand it all in order to set it up and start using it. Like we designed it so that it knows for you. And then as you use it, you start to learn. So
And it has
what
a
do we have
feature
for-
to like just pull like and send whatever your accountant needs to, right?
Correct.
Something like that. Yeah.
Yeah. And this I'm going to brag about because I'm kind of excited about it. We just
Nerd
did
out
an
for a
overhaul
second.
on the mobile app. I'm like totally geeking out about it. The new mobile app is awesome. If you're on here and you're a user and you haven't downloaded the new app, go download the new app and then text me and tell me you love it. If you hate it, you can text me too. That'll be way less exciting for me, but I'll take the feedback. But I think you're going to love it. The new app is super slick. Again, you can do everything on the go that you can do there. So very, very cool. And press of a button, you can send everything to the account. Okay. Any questions, comments? probably overwhelmed, brain fried hour of me talking about taxes like the micro machine man.
Thank you very much for this, Matt.
You are very, very welcome.
Thanks, Matt.
Absolutely. All right, going once, going twice.
We are on for next
Next week.
with a special guest. So
Yes.
we'll send out some more info, but see you all here again next week, hopefully.
Awesome. Bye, everybody.